This is a video on national income accounting. The goal of this video is to understand how to measure aggregate amounts, the aggregate amount of production in an economy, to appreciate the importance for measuring this, and to learn some problems with these measures. National income accounting is the science of how we measure an economy's overall economic performance, focusing especially on the overall level of production of goods and services. Why is this important? Well, the reason we care about jobs, income, etc. is that we use the income to buy goods and services. Total production of final goods and services is approximately equal to national income. We can use these measures to assess the health of the economy by comparing output per person across countries and across time periods. We can use these measures to track the long-run growth of the economy. And we can use these measures to assess the effectiveness of macroeconomic policies. The measure we use most is gross domestic product. This is the total market value of all final goods and services produced in a given year. It's necessary that we use a monetary measure because we're literally adding apples to oranges to tractors to computers, etc. So we use a market value. To avoid double counting, intermediate goods are not counted, only final goods. I'll explain why on the next slide. GDP excludes financial transactions. And finally, GDP excludes secondhand sales, or sales of used goods. So, let's use an example to illustrate why we do not count intermediate goods. Let's talk about the birth of a suit. A sheep rancher produces and sells $120 worth of wool to a wool processor. That firm processes the wool and sells the material to a suit manufacturer for $180. The suit manufacturer makes a suit and sells it to a wholesaler for $200. The wholesaler stores the suit, ships it around the country, and eventually sells it to a retailer for $250. And the retailer sells the suit to you for $350. If we counted all these transactions, we would get $1,100, when actually all we have at the end of the day is a suit worth $350. This is the reason we only count final goods. Well, what's not counted? Financial transactions are not counted, such as public transfer payments, such as Social Security payments and veterans payments, private transfer payments, such as gifts between family members, and stock market transactions. All these financial transactions are not actually used to exchange goods and services, so they're not counted. Secondhand transactions are also not counted, as they contribute nothing to the production of final goods and services. They are simply just moving ownership of final goods between people. Some shortcomings of GDP. One, it does not account for non-market activities. For example, you could clean your own house, or you could hire a maid to clean your house. If you do it yourself, it's not counted towards GDP. If you hire a maid, it is counted towards GDP, even though these are exactly the same activity occurring. The value of leisure is not added towards GDP. In 1900, the average work week was 53 hours. Today, it's only 35 hours. Production today is lower than it otherwise would be if we worked longer, but we're happier with the leisure than with the extra stuff. But this leisure, the value of that leisure, is not counted towards GDP. Improved product quality is often not counted towards GDP. For example, a $300 computer today is much better, much more powerful than a $3,000 computer in the 1980s. It does not include the underground economy, so this could involve illegal activities such as the production of drugs, or it could account for innocent things such as you hiring the neighbor 12-year-old kid to mow your lawn. In small underdeveloped countries, an underground economy can be much bigger and important than it is for a country like the United States. It does not include external costs. Imagine an oil spill. The costs imposed on society for cleaning up GDP is actually added towards GDP. And finally, it says nothing about income distribution, whether the production of goods or services or the consumption of goods and services is spread out equally, fairly, or unfairly.